that Alok Sama, founder and president with Bear Capital, joins us. Alok, good morning and thank you for joining us. Alok, do you see India outperforming emerging markets in 2014 and hitting record highs?
Before I talk about India, let me spend a couple of minutes talking about EM more broadly. 2013 was a year of very significant underperformance for emerging markets generally. I believe EM underperformed the S&P 500 by close to 30%, and that's very significant. And not just the US, significantly underperformed MSCI Global. And that is not a one-year phenomena. That's been a trend that's been in place for a few years. So the question one has to ask in 2014 is: do we see some mean reversion? In other words, EM outperformance to make up for a sustained period of underperformance, or are we in a longer-term secular trend? Are we, in other words, talking about continued very significant underperformance for emerging markets? I, for one, am in the latter camp. In other words, we do see significant headwinds getting in the way of EM performance. I think there was a great Goldman Sachs study that was published towards the end of the year, which talked about structural fault lines going through the major emerging markets, the BRICS in particular. And with India, the issues are fairly obvious. Governance is right at the top of the list, but there are other very significant fault lines too, which we can talk about. But the broad point is that we do believe, or I subscribe to the view, that we are in a period of sustained underperformance for emerging markets. Within emerging markets, India suffers by comparison somewhat for two reasons. One is India is reliant, excessively reliant, I would say, on portfolio flows to fund its current account deficit. And as the tide of global liquidity turns, Fed tapering is the talk of the day, and that's what everyone's watching. India is vulnerable relative to other emerging markets, such as Indonesia, for example. Indonesia is in the same camp too.
Alok, hi, morning. So do you think in the medium-term political events and general elections will be impacting markets here and would act then as a catalyst?
So governance and politics are the keys to Indian market performance for the next 6 months to a year. And, there is the overlay of what's happening in the macro picture, but politics is fairly fundamental. The markets have formed a view, I think rightly, that a BJP government will be more pro-business, more pro-liberalization, more right-wing, which is, will undertake a lot of the reforms which the current government, the incumbent, has been very slow to, has been unresponsive in the eyes of the world. So the market's kind of bought that story, and to the degree that the picture pans out the way one might hope, with a BJP victory, and Narendra Modi as Prime Minister, and most fundamentally a stable government as opposed to an unstable coalition, that will be very bullish for the market. So you could see some very significant outperformance on the back of that. I, for one, am inclined to be extremely cautious. I think the political picture in India is murky. The one thing, while certainly there is a very strong anti-incumbent sentiment in India, you saw that in the state elections, Delhi, of course, being the extreme outlier, it's not by any means obvious that the BJP is going to be in a position where they could form a stable uniparty type government. It's going to be, I think the likelihood of some type of unstable coalition is high. And by definition, some of those outcomes are, the electoral calculus is inherently unpredictable. So I'm not sure what we're going to end up with. So I for one, am inclined to be quite cautious. But there is absolutely no doubt that politics will be a major driver of market performance in the next few months.
So Alok, how do you see the currencies shaping up in 2014, especially yen and rupee, and do you see some further weakness here?
Well, the yen and rupee are two very, very different dynamics. The yen, what's happening in Japan, is of limited relevance to India, but Abenomics, the Japan is very clearly on a mission to inflate the economy. I mean, a big enemy in Japan is deflation. It's been in a sort of a deflationary debt spiral for almost 20 years. So the Bank of Japan is committed to print money and basically do whatever it takes to inflate the economy. So that's actually a wonderful one-way bet for the next 2 to 3 years, and you could see the yen go to, who knows, 140, 150, even 200, and that's not a joke, by the way. I mean, I think you could get there within the next 2 years, because that is what the Bank of Japan wants to do, and the mission is basically sort of whatever it takes to get there. With respect to India and the rupee, that's a completely different set of factors that drive that. I think what's happening in Japan is of very limited relevance there. I think with respect to the rupee, a lot has to do with what's happening with the dollar, and to the degree that the Fed, to the degree that the news flows out of the U.S. in terms of what's happening with the employment picture are fairly robust. You will see the Fed embark on a tightening process, pulling back QE3, tapering, etc., and that will affect all EM currencies very significantly. I, for one, have a fairly benign view in terms of where the Fed is headed, particularly under its new leadership. I think the Fed in monetary policy is likely to, or on the side of being dovish, and so I don't see any dramatic pulling back in terms of monetary policy or monetary tightening, which I think again is good for most EM currencies, particularly the rupee.
Alok, pharma and IT continue to shine, backed with strong earnings growth as well. Do you think it's time to switch to cyclicals and infrastructure?
I think switching to cyclicals and infra is probably a good play in light of a liquidity cycle in India that's likely to improve with lower interest rates. And then once again, the politics is a wild card, to the degree. I don't think anything much is going to happen in the lead up to the elections, but there've already been in the background, while the markets are very focused on the political news, the Congress actually has been surprisingly proactive over the last 6 months in terms of approving a lot of measures, sort of clearing the backlog of projects that should have been given the go-ahead. And I think you will see the infrastructure sector benefit from that. And who knows, with the new government in place, that may well accelerate. So we'd be in favor of cyclicals, in favor of the interest rate sensitive sector. Some of the defensive pharma or consumer valuations have become so stretched that I'd be inclined to reduce our allocations there.